Hello and welcome. You're watching The Money Show, your one-stop destination for your personal finance queries. I'm Kavita Thakliyal, and today again we have got your Power Pack show where we'll be talking about interesting strategies, looking at the market volatility and fall, and how can you rejig or revamp your portfolio adopting these strategies, and how can you get closer to your financial goals with taking minimum risk will be discussed on the show ahead. But then we will also answer your portfolio queries. So just in case you want to send across your questions, you can do that on our WhatsApp number, which is 86579745571. You can also email us your queries on themoneyshow@etnow.tv. Alright, so let's begin the show, and today I have with me Shweta Rajani, Head Mutual Funds, Anand Rathi Wealth. Hi Shweta, good evening and welcome to the show. And so when we talk about strategies, it's very difficult to actually to believe that you'll be having a portfolio where there'll be so much of loss or red, especially for people who just invested 3 years back or maybe 2 years back. So for them to look at such a market and to, have the guts to keep investing, continue investing, even if it is their SIP, it is difficult to digest for them. And when you talk about having strategies where you can mitigate your risk and you can actually diversify your portfolio and secure those returns. It sounds unbelievable. But here, this is the show where we talk about basic rules of financial planning, basic personal finance that will always keep you safe and secure, especially times like these, where we are seeing heavy fall and a correction, which was again overdue. And although the way the market was earlier, where we saw an undertone bull run, which was temporary, this also is temporary. But when we talk about strategies, what do you think can be the first thing that one should adopt, especially a mutual fund investor?
Absolutely. Good evening. Like you rightly pointed out that recency bias could hit in, and where you've not seen such a significant correction in the last few years, it can get an investor worried. But I would say the first and the foremost, or the most basic strategy that one has to adopt when investing in, even if it's a mutual fund, is to have the right asset allocation in place. One cannot have a portfolio which is a 100% equity mutual fund portfolio. Imagine a year where there is a 25% correction, your portfolio would be down from 100 to 75. But if you have the right asset mix, let's assume you had 80% equity, 20% debt in your portfolio, that 20% debt would still yield you around 7%. So compared to a 100% equity portfolio, you'd probably be down 20% rather than 25% down. So having the right asset mix becomes very critical. Even if you have a 10-year horizon, even if you have a 15-year horizon, you cannot have a 100% equity portfolio. What asset classes, should you therefore go in for? You have equity, debt, gold, real estate. But then when you make your choice, what you should keep in mind is costs, liquidity, taxation, and the return and risk ratio. So this, I would say, would be the thumb rule that you should have when you're looking at strategizing and how you can minimize your risk.
So, Shweta, now let's take scenarios, because we are talking about investors with different kind of investment horizons. We're talking about investors, who just have their goals coming up. We're talking about investors who have sufficient time for their financial goals. We're also talking about investors maybe who've just started investing 2 years back. So for all of them, their experience in markets would be different, okay? Although what you said is the basic rule, diversify across asset class. But when someone is new to equity, especially, the new tranche of investors that came 2.5 years back, most of them just have a lot of equity because they were getting good returns. They just kept investing, and now the portfolio is totally, it has a larger chunk of equity as far as investment is concerned. So considering all these scenarios or all these type of investors, diversification across asset classes, across equity becomes the common rule. But when to strategize and how to strategize? What if someone doesn't have gold in their portfolio? Real estate, let's assume people have mostly, in physical form, and that is not something that you might just want to move around so quickly. So that kept aside, what should be the action plan in your portfolio right now?
Absolutely. Kavita, while you mentioned that last 2-3 years, people who've been investing, they would not just be equity heavy. I'm sure there'd be mid and small cap heavy within that equity. But leaving that aside for the time being, see, how do you strategize? Let's assume the first thing of a year, therefore, becomes goal setting. Decide your goal before you start investing at whatever age you're starting. But you should know for what is your investment horizon. Now, you could be someone who started 2 years back and you have a 20-year horizon. So you may be having an 70-80% equity portfolio, which is fine. During periods like this, take it as an opportunity, continue with your investments and maintain your asset class. You could have a second category of investor who, let's say, has your goal, which is likely due in the next 1 year or 1.5 year or somewhere around that. Here it becomes very important that if you have your goal, which is coming up and it cannot be postponed. Let's assume you have a child's marriage and this goal cannot be postponed. What you have to ensure is whatever amount you need, a larger portion of that should be shifted into debt, so that any kind of a market volatility that you are witnessing right now does not impact your goal achievement. So 1 year before, what you need in terms of your goal amount should be shifted into debt. That's one strategy you should adopt. Second, I would say always have an emergency fund. Even if your goal is, let's say, 10 years away or 5 years away, ensure that at least 6 months of your living expenses are parked in something which is not market linked. That is another strategy that you should adopt at any given point of time. Third, you mentioned about having gold in the portfolio. So see here again, if I compare gold with equity and debt, then over a longer time period, gold could give you returns which are slightly more than debt. But from a risk standpoint, even they go through long periods of cycle, and their risk would be in between debt and equity. So if you want to have some gold allocation, because you may want to also consume gold at a later stage, maybe a 5-10% of gold, but primarily your portfolio should be constructed around equity and debt as a good combination to have.
Also, Shweta, let's also talk about investors now who just have mid cap and small cap in their portfolio. Now, how do you go light over there? Do you shift all your money in large cap? How do you rebalance your equity portfolio and maybe go large cap heavy? Just because we'll be seeing a lot of volatility and mid cap, small caps are, the froth. We were talking to a lot of experts and a lot of fund managers. 70 to 80% froth has already gotten cleared now. But there are few pockets wherein mid cap, small cap valuations are still high, so there could be further more correction that we might see. Having said that, what should be the strategy to go heavy in large cap? Should we be going heavy on large cap? People are invested through active, passive also in large cap category, and the same scenario we are seeing in mid cap, small cap also. So how do you reduce that?
Sure. So, firstly, when we say that it's, a lot of the valuation is corrected, absolutely, given that you've seen almost a 15% correction in large caps and, 20 odd percent in mid and small, your valuation pretty much, I'd say, has come closer to what we would call as a reasonable valuation. Now, small cap as a segment, you know, uh, it is a segment which at least has 250 odd companies, just the small cap 250. I'm not even getting to the micro cap index here. But within that 250 companies, you'll find something which is available to you at a 15p, something that's available to you at a 100p. That is where it becomes very important that you give your money to the right set of fund managers who are able to identify where the good value is. So it's not that mid and small cap is a complete no, or you should completely shift out of your mid small allocation or stop your SIPs in mid small and shift to large. I don't think that is needed at this given point of time. A good combination of large, mid, small is what is needed at all times, and even in times like this. So let's say if you had gone overboard, maybe you had gone to 60-70% mid small, yes, that's needed, that needs a correction. So I'd say having a 40% mid small, 40 to 45% depending upon your risk appetite, that's still a good allocation to have in the portfolio. So if you are not there, then maybe you should shift out from your small cap funds, enter into large cap oriented categories, something like a pure large cap fund, a flexi cap fund, a dividend yield category fund, which have a high or a bias towards large cap, is something that one should consider at this point.
Now, specifically, you advised to diversify across asset classes. The right route to invest in gold and silver would be buying an ETF.
Yes, absolutely. It's cost effective and tax effective. So that would be the best route for someone to participate in commodities.
People have also invested in thematic and sectoral funds. Now, what to do about that? Should you stop your SIPs in it and maybe just let the money be over there and maybe just divert that SIP into a purely diversified fund?
Yeah, that I would suggest. See, because most of the times in my experience, when I talk to a lot of investors, they don't really understand that sector or theme, or it's not that they are tracking it very closely. But most of the investments go there because maybe so many NFOs are coming in that space, or they've heard from their friends and close family that, oh, this sector looks good. So, which is where you would rather not have your SIPs in sectoral or thematics. It needs timing and it needs close monitoring. You would rather leave that to a diversified fund manager who is taking these sector calls on your behalf any which ways. So, if you have SIPs there, you can stop and go in for diversified funds alternatively. I'm not saying stop and sit on cash. Switch from a sector fund to a diversified fund.
Shweta, I can just keep asking you questions on various aspects as far as this topic is concerned, but then we really have to take a break and we have our viewer query section also waiting on the show. So let's take a quick break, and for all the viewers who are also concerned about their portfolio profits or maybe the performance of their funds, you can quickly WhatsApp us your queries, email us your queries, and we will get your portfolio queries answered by our expert. A quick break, and post that, let's connect with our viewers. Welcome back. It's time to answer our viewer queries, and I'm joined by Shweta Rajani, who will be helping our viewers today. And Rajesh Kannan from Bangalore wants to ask his question. Hi, Rajesh. Good evening. Rajesh.
Hello.
Hi,
Yeah.
good evening.
Yes.
Can you hear me?
Yeah.
All right. So you want to invest lump sum, 10 lakhs?
I guess, yeah.
Okay.
For STP, yeah.
Okay. So I just want to know what's the investment horizon, the time horizon?
It's a long term. It's already 7 years, I think, 7 years.
For 7 years at least. Do you have a current mutual fund portfolio?
No, already this is I booked some profit that amount, right? I booked some profit from that mutual fund.
Oh, lovely. Okay. So you
Okay,
have
so
booked
this,
profits and you want to invest that again in the markets. Okay.
Market again. Yeah.
Oh, lovely. Okay, let's just help you out with this strategy. So, Shweta, interesting. But would you recommend to invest this money again in the market, or you would recommend him to just park this money? But the time horizon is 7 years. Maybe he can have like a hybrid approach. What do you think?
Yeah, Rajesh, I don't know what your overall asset allocation is, but I'm assuming you have, some debt in your portfolio as well. And this is just the money that came out of equity because of some profit booking that you've done. So, to my mind, this can, if you are maintaining your asset allocation, then if this has come out of equity, it can go back into equity, and you can go in all now, because this was anyways there in equity for you. So it's just that you're going to be shifting from one scheme to maybe another scheme. So yeah, since it's 10 lakhs, I think, what I would suggest, few schemes for you. I'm telling you a portfolio which would be spread across large, mid, small, and balanced across different styles. So what you can do is you can go in for a portfolio of Quant Active, ICICI Pru Dividend Yield Fund, HDFC Flexi Cap, DSP Equity Opportunities, and SBI Contra. So you'll get a good mix of large and mid kind of a portfolio.
All right, Rajesh, anything else you want to ask Shweta?
No, yeah,
okay.
That's fine.
All the best, all the best. And before we get on to our other viewer, let's cut into a press conference from Cabinet of Economic Affairs. They are addressing a press conference on Q3 GDP numbers.
And part of it is either due to or because either due to the FPI flows or FPI outflows or a consequence of this. So there is a two-way relationship between the two. And as we speak today, we notice that the US stock market is significantly down, and the Indian market today has reflected that as well. But as a recent commentator, one of the long-standing observers of the Indian market, Mr. Chris Wood of Jefferies, earlier he used to be in CLSA, and he has said that from a long-term perspective, he continues to remain very positive on Indian stocks. And the growth numbers we have seen, including the revisions to previous years, validates the point he makes, which is about the long-term attractiveness of the Indian market at this stage. Notwithstanding recent volatility, which is partly driven by global developments and also partly driven by stellar gains of the previous years. Next slide, please. The central bank in the last 2 months or so has been unwinding some of its unintended monetary tightening and also credit tightening that happened in the course of the current financial year. In fact, starting from the previous financial year, not only have we witnessed a reduction in the repo rate and the cash reserve ratio, and also the higher risk weights, which were mandated in November 2023 when uncollateralized, unsecured consumer loans where risk weights were restored to the pre-COVID levels. But now that these loans have growth rates have come down, RBI has withdrawn the increase in risk weights mandated in November 2023. So the non-food credit growth, which was 17.1% in FY23, at a peak is now at 12.4%. But considering the nominal GDP growth of 9.9% projected this year and 12% last year, non-food credit growth is not trailing nominal GDP growth, and that's a good sign. Next slide, please. In terms of outlook for capital formation, which is what we turn to next, import of capital goods has been steadily rising, and that is the share of capital goods in total imports is about 20% compared to a figure of around 17 to 18% in FY22 and FY23. And the production of infrastructure and capital goods in the 3 quarters of the financial year compared to the previous financial years, whether it is capital goods or infra construction goods, you can see a steadily rising trend, which augurs well also for capital formation. Next slide, please. Private investment intentions after a dip in the first quarter due to election-related uncertainties in India, and therefore they are again picking up in Q2 and Q3, as this chart very clearly demonstrates. This is the value of new projects announced by the private sector. Next slide, please. And also, if you look at the labor market, unemployment rate is down to around 6%, and the labor force participation rate is comfortably above 50%, and we are seeing a steadily rising net payroll additions based on EPFO records. So after a dip in the first 2 quarters of the financial year, this is also in a way consistent with the improvement we are seeing in the GDP trajectory and the projected implied growth rate.
All right, so Chief Economic Advisor V. Anantha Nageshwaran, press briefing where he was talking about the GDP numbers. But then let's move on and let's connect with Saravanakumar from Coimbatore. He wants to ask his question live. Hi, good evening, Shravan. Thank you so much for sending us your question.
Good evening.
So we have the fund's name. Are you investing in these funds or you have just selected these funds?
Yeah, just selected this fund.
Okay. So what's going to be your investment amount and for how long are you planning to invest?
5 lakhs for 10 years.
What's the SIP amount?
A lump sum or SIP, both.
So you are doing lump sum and SIP also?
Yeah.
Okay. So lump sum is 5 lakhs.
Yeah.
5 lakhs in each fund or 5 lakhs in total divided into these funds?
Divided into these funds.
Okay. And what's going to be the SIP amount?
SIP 5,000.
5,000 each, right?
Yeah.
Okay. All right. Any specific corpus that you want to accumulate?
Yeah. Want to accumulate up to approximately 50 lakhs.
50 lakhs. Okay. All right, Shweta, we've got enough clarity now.
Absolutely. Saravanan, so I guess, you said a 5 lakh of lump sum and then a 5,000 per month of an SIP, if I heard you correctly. So, yeah, in terms of if your goal is 50 lakhs, maybe a 5% step up to the SIP could get you to your goal very easily. I also looked at the schemes that you've mentioned. While most of them looks good and you've tried to, have one from each category, get a large mid exposure. Just two recommendations that I had for you. See, you've picked up one dynamic asset allocation fund. Now, what happens is, I am assuming that you already have decided how much equity and how much debt you want at your overall portfolio level. So let's assume you decided I want to have 80% of equity. Now, within that 80% equity, you're picking up something which also has some debt, which may not meet your overall requirement of how much debt you wanted. So separately managing equity and debt can yield you a better result and get you more efficiency in the portfolio. So I would suggest not to invest in that dynamic asset allocation. Second, for your gold investment, you've gone in for a gold fund. Now, what would happen is, gold fund generally has a higher expense ratio as compared to a gold ETF. So if you want a gold exposure, would rather go in for a gold ETF than the fund route. One or two other funds that you can add to your portfolio, I would say you go in for a Kotak multi-cap and an SBI large and mid-cap fund. The rest of the schemes you've chosen are fine.
And it's time up on the show as well. Thank you so much, Shweta, for taking time out for this interaction. And for all our viewers, I'm going to sign off, but going to leave you with our WhatsApp number and email ID. Thank you so much for watching. Goodbye.